Good morning, good afternoon, good evening to all those who have joined. Thank you so much for taking your time out and coming and listening about India, about what the Indian opportunity is, how we at Quantum look at the two major issues that we think about risk and investing in India, which is valuations, especially in public equities, and we'll talk about private assets also in terms of valuation, and the very important aspect of governance. How should people think about governance? These are the two risks. We don't think standard deviation, macro risk, volatility, currency can all be managed, priced, but it gets very difficult to price governance. And we also know that it sometimes gets difficult to try and price valuation. So Ajit, over to you. Let's start off, and then we will try and do about 35-40 minutes of slides and talk and discussion. And then please feel free to ask us questions through the question box or by using the raise hand feature. Ajit, over to you.
Thanks. So, just to go back a bit in history and to kind of anchor this, when, in the year 1990, I, wrote an article in the Wall Street Journal, and the entire background was if India liberalizes and GDP grows, you'll get companies having more revenues, more profits, higher EPS, and higher share prices. So we kind of recognize that linkage between GDP growth rate and stock market returns. And you can see from this article way back when we were sort of right, I guess, in what we wrote about 34 years ago. And going back 500 years in history, basically Angus Madison, University of Groningen, the late Angus Madison did this chart to indicate how GDPs of different parts of the world have grown and some cases evaporated, like China in the red evaporated, India in the yellow golden color evaporated, basically industrial revolution. Then you start looking inward, become socialist, communist, shut yourself off from the world. And then as you begin to open up, in the case of India, 1991, in the case of China, whenever Nixon, went to China in 1971, and China began opening a few decades after that. So you can see that massive shift from the old age till now. And this will carry on.
And the way we also talk about this is because, as you can see, the charts going out to 2030, 40, 50, that India's weight in the global portfolio is going to increase. And it is for institutional investors and investors to think what should be their ideal weight in India. So, and it will take, if you have to have 4-5% of your portfolio invested in India, and that is already India's weight in global GDP, it will take effort. It will take, aspects of what asset class, what kind of partnerships do you need? Do you need, external managers, internal research? How are you going to invest directly? There are many aspects. I think most investment committees should start thinking about that.
And also recognize, even if you go to 4% today, you're basically behind the curve.
Correct.
Right? So if you look at indices, which are created on history, indices are not useful at all in this.
Absolutely.
So there's a lot of discussion that at the trustee level, at the investment committee level, where CIOs have to really think, basically what is the time horizon? Is it 1 year? Is it 3 years? Is it decadal? If it's decadal, you got to have more goals. And again, talking about decades long history, if you look at India as an economy from 1980, when the first reform started in a small way, then 1991 was a big bang. So over 44 years, we've had a 6.2% rate of growth in GDP, which is more than twice the global average across governments. Right? In black, you've got single party. In red, you've got coalitions. And now Prime Minister Modi in his third term has come in as a coalition. And already you're seeing the fact that coalition governments tend to do better than single party governments.
Right? That's what our case has been for the last 44 years.
And all of this ultimately should or should not translate to stock market returns. When you allocate capital to a foreign country, to a growing emerging economy, you're hoping that that green line of stock market returns. On the left side, we've got China, where you've got the black line of GDP growth rate, of GDP growth. And the right side, you've got MSCI China, of China on the left side. On the right side, the black is India GDP, and the green is MSCI India. Very strong correlation in India. And in China, it's broken.
We've always get asked this question saying that why so? And we generally said that India is a democracy. So there is freedom of property rights and freedom of action and freedom of making decisions. We've also seen Indian companies have, in that 44 years that you showed, there have been a lot of changes, but there have been still hindrances. And the Indian companies have learned and adjusted and know how to survive in a political environment which is not exactly capitalist, but it's not completely socialist communist as well. So I think to these two aspects of rule of law, democracy, and a fairly aspirational private sector, individual as well as corporates, combine to help ensure that that macro growth that Ajit talked about, 6.5% real GDP, 11-12% nominal GDP, gets reflected in the
And it's
stock market
something in which you
over
can
time.
participate sitting no matter which part of the world you're
Absolutely.
in, as a public listed equity investor, right?
Correct.
Easy in, easy out in
Yes.
that sense.
Yeah.
And what have the foreign investors done in India? 1991 was the year that foreign investors could start buying shares in India.
Yeah.
On the left side, you've got the FDI, which is the foreign direct investment, multinationals building factories, etc. China on the red far outclasses India, outstrips India big time.
Yeah.
On the right side, also on the portfolio flows, China got a lot of attraction, as opposed to India, which is in blue. There may be a change, and we'll see the changes happening given what's happening in geopolitics now. But as we see in the next slide, what you've seen since pre-COVID, when I would say the birth of the top five and then the Mag 7, when you had that going on, you were trying to mimic and saying, can I find those companies in India?
Yeah.
Can I do private equity, infrastructure, venture capital in India? The investment by foreigners in private assets in India has taken off from 2017-18 and continues to.
It does.
And we've seen headlines recently of DOJ, SEC coming to India, which goes to the last part of our discussion on what's going to happen if you invest in partners who have got weak governance. We'll come to that later.
Just one more point, like if you look at that FDI slide and this slide, a lot of the FDI that comes to India has come through what we call financial investor, their financial private equity venture, maybe a bit in financial infrastructure. And when I say financial, it's institutional investors as compared to corporations. Like a lot of FDI into China was corporations setting up factories and producing and manufacturing and building supply chain. In India, we've seen a bit of that, and I think it will improve. But a lot of the FDI capital, because private equity gets categorized as FDI, a lot of it is private financial institutional capital as compared to corporation capital.
And the way we think an international allocator and the way we suggest they should invest in a triangle of opportunities in any structure, the foundation is the most solid part. Right. So in the triangle, where we operate Quantum, we give international allocators listed equity, liquid, we've got a valuation criteria, we've got a governance through this integrity screen that we started in 1996. And we talk about in some other webinar that we have this ability on the value fund to forecast or estimate 2 years into the future what your likely returns are going to be if you invest in the value portfolio with us. We've had that phenomenal track record for 200 months plus of making those estimates. So,
and the reason we show that risk rising is not about it could be about valuation, it could be about market volatility, but it's more about liquidity as you take more risk, as you get into say small caps or you get into private equity and venture. We're not even talking about real assets like infrastructure, real estate. The scale of liquidity and governance risk that you take on and pricing increases. If you're able to manage that, great.
I won't say increase, I said rises exponentially. Exponentially, because you go to legal system in India, it takes 20 years to get a case cleared in court. So you don't want to end up in a situation where you're on an illiquid stock and you're fighting with some other founder. But what we have seen is a complete flip. As you saw in those previous charts, we're seeing international investors allocating a lot to illiquid assets and a lot less to liquid assets, which are more predictable in their outcomes. I would say even small cap, mid caps are not that liquid in the public markets in India, and the outcomes certainly are not as certain.
And it's not even scalable. You can't put too much capital.
So the outcomes are not not so scalable at all. Sense. And finally, little pitch on what we've done since we began to audit our track record in August 2000, over 24 years. Our track record has been significantly better than that of the compulsory BSE 500 total return index as mandated by the Indian regulator SEBI, and of course significantly higher than the MSCI India index, which is in green, and then you got the S&P 500 and others. These are all in dollar terms.
These are all dollar terms.
People are surprised that we've outperformed the S&P over a long period of time by basically 1.9x. So good place to have invested. and still a great place to
That
invest.
just
So
tells
we'll
you
come
that
back to that.
public equity in India is actually a very, very good asset class. If you can manage some of the risks that we will talk about, it's actually a very good asset class. And down in the bottom, the two charts are Shanghai Composite and MSCI emerging markets. That also tells you that how much India has done better. And if you had dedicated allocations to India, that portfolio component.
I mean, for those allocators, they say, we have India through emerging markets.
Correct.
They should look at this chart and say, we made a mistake by saying we have India through emerging markets. I need a mandate to give to away to.
I've only heard one in my discussions with many investors, one investor who said that we look at US and India as their public equity allocations. And that's our mainstream allocations. And then everything else is, if you want to add, and which is very rare. We haven't.
But the tide is turning. We can see that.
Correct.
There's a lot of interest now.
We'll just talk to you about a bit about opportunity. And Ajit, this was the webinar that we had done a few months ago. This slide is the summary of that webinar. We just thought that India was becoming TINA. There is no alternative. And whenever we've seen India becoming a theme, we get a bit worried. And I think as investors, you also should be getting worried. And that's why we highlighted our aspects of saying that India is a great opportunity. But, we try and figure out what is the hype, what is the reality of what we want to see. And this slide just looks at the three major aspects: democracy, which is very essential. And we showed why India and Indian markets and GDP are so, and then where China is like this. And one answer could be democracy in that. The other, of course, is demographics, and that is the biggest opportunity, or it could be a big risk, and how that plays out. And the aspect of development. Can India grow and create jobs and create the opportunity for its people and for investors? So if you look at, in terms of hype on politics, and as we showed over that chart of over 44 years, it has not mattered. It does not matter whether the government is on the left or the right or single party or coalition. If your expectations from India is 6.5% real GDP, double digit, low double digit nominal GDP, that can happen irrespective. Of course, we cannot take it for granted, but India has the levers and has the aspects to be able to do that. And we've seen that, and we think it will continue for at least for the next 10, 15 years as the demography remains. Jobs and population is something that we'll talk about in the next slide. It is by far the biggest risk that India has. It's an opportunity, it's a risk as well. And then we'll talk about aspects of growth. We still think that India is not growing as fast as it should. When I say it should, it means to be able to create the jobs it requires to be created for its young force. I don't think India is growing as fast. And you might read about India will be the third largest, and India is the fastest growing, and that's all true. But it is not fast enough. Like if you look at China, Korea, Japan, Taiwan, when they grew for over 10, 15 years, they were able to grow double-digit real GDP growth. And we haven't seen that. I don't think that will happen in India at that pace. As I said, the biggest issue is jobs. And if you look at the right slide, for the last 7, 8 years, the growth in employment has been static. It's about 400 million people are employed in the Indian labor force. This is, of course, CMI data. If you look at the new government data, they are saying that the total labor force is about 550 million.
Yeah, but they've got a very different and loose definition. Even someone of women.
Yes, of women working in their own households.
Skews the data a lot.
It is correct in terms of ILO, but it does not add anything to the income of the household. The income of the household or the activity of the household remains the same. So this is CMI data, which is different. But you've seen some increase in the last 2 years, last 2-3 quarters. We've seen an increase in employment. So and we will talk about that. But otherwise, in India, we need to create, as the blurb shows, 27,000 jobs per day. And we have a similar other problem in the OECD world where there are 25,000 people retire every day. So it's a very different challenge, but this is a big risk and a big opportunity. But this is also the case to think about, where is opportunity. And so if you look at these numbers, now 100 million tax filers and about 30 million paid taxes, that 100 million number 10 years back was about 40 million. So, you've seen an increase in the number of people who are earning more and paying taxes. Mutual fund accounts, I think when we started the quantum mutual fund back 15 years back, it was about 10 million was unique investors, and now there are 50 million unique investors in the Indian mutual fund space. So you're seeing, as the Indian demography, which is about 29 years of average age, as that demography increases, and as people get reasonably good jobs, their income increases, their consumption will increase, their savings will increase, and so you're seeing all that, but still there is a long way to go, in terms of either getting to a middle income or advanced income category. I don't think
So I'll
that
just
is.
go back a bit in
Yeah.
history on this about the consumption cycle, right?
Yeah.
I think every foreign company that comes to India, the
Correct.
multinationals
Yes.
or the private equity, they think, oh wow, there's 1 billion
Yes.
people are going to brush their teeth with Colgate
Correct.
toothpaste and drink a Coca-Cola
Yes.
and all that stuff, right? I remember in the 1990s when I was working with Tom Hansberger in
Yeah.
Fort Lauderdale, and I was managing the Vanguard International Value Fund, which I did for 4 years, sitting out of Florida. Ford had opened a factory in India,
Yes,
along with Mahindra, to
yes,
make
correct,
cars.
yes,
And I remember their CEO, I forget his name, went down to India to inaugurate the factory. And I read this in Florida that he on Bloomberg that he was saying, oh, we're going to be selling 60,000 cars or whatever it was. I think they actually sold the factory out because
Yeah,
they didn't sell any
shut it.
cars at all.
Correct. Yeah.
I think they sold more cars in the Ford dealership in Fort Lauderdale, Florida in
Wow.
1 year
Yeah.
than they did in all of India when
Correct.
Ford first came in.
Correct.
They got the pricing wrong, they got the product wrong. They
Culture,
got everything. It's
so
completely
many
wrong,
things.
right? So I think it's also difficult, and the same thing applies to small cap, mid cap.
Yeah.
Just because you buy into a company that's successful in a region in India,
Yeah.
you assume it's going to be a success across nationally.
Yeah.
That's not the case. It's a very different market, different languages, different preferences, different colors, different everything, at least for now.
But we do see something changing, and so this is the consumer sentiment, and it's a good way of thinking about what people are thinking about today and whether they have a job, their security. And you can see that drop during COVID, where people, a large part of the Indian labor force is what we call informal casual labor, which got completely impacted when the lockdowns were impacted. And you've seen a very long cycle for it to come back, but finally consumer sentiment both in urban India and actually slightly higher in rural India has come back above peak, above the pre-COVID level. So it has taken very long, and it also depends. It also shows that the government spending and the government response on income support was lesser than what should have ideally happened, because COVID happened after demonetization in 2016, the GST impact, the credit crisis that we saw in 2018, which actually had a big funding problem, and then COVID. So we're already seeing consumption slow down, and then COVID happened. And so, but we are finally seeing what we call India is still in a cyclical uptrend. We are still on a structural. When I say structural, means can India grow at 7.5%, 8%? I don't think that is happening yet. But can India get back to its 6.5% number? You will see some numbers which were higher, but if I look at trend GDP, it is still below the COVID level, but we are getting close to it. And there are certain other aspects on the balance sheet side. Household balance sheets are not as strong as you can see that in the consumer sentiment, and you can see in household liabilities also, it's not as strong. But the other two balance sheets, the bank balance sheets, if you look at the NPA ratios have gone down, and the corporate balance sheets. The corporate balance sheets actually at a much better position than we've seen for the last 10, 15 years. Which tells you that if there is demand, and that's when the consumer sentiment, if that plays out and sustains, you should see a reasonably good
it would
investment
mean
cycle.
that, yeah, it would mean that what you just said was that the consumer balance sheet is kind of stretched. If we had a graph on that,
Yeah.
it would not be at the trough, it would be at a peak in that sense. But
Yeah.
if you looked at the balance sheets of corporate India on the
Yeah.
investment cycle,
Correct. Yeah.
so GDP will kickstart
Yes.
when the investment cycle kickstarts.
Absolutely. Yeah.
Right? And the investment cycle will kickstart when the supposedly already tired consumer,
Yeah.
who's got a stretched balance sheet, saw the consumer sentiment chart,
Correct.
continues to inch upwards, and it breaks the capacity utilization
Yes.
at some point, and
Right.
then the investment cycle starts, right?
I think the holding back is still consumption, income. So as companies see more demand, and the China plus one thing also has not played out as much as India hoped out to, right? So one way is to access domestic consumers, other way is to access the global consumer through exports. And barring Apple, which has been a significantly huge success from them, like Apple assembling phones, and now they moved from phones to iPads and iPads to AirPods. That spawning of the ecosystem that we were expecting is happening, but happening in very few sectors, not happening all across. Maybe we'll see some more activity. We are seeing Tamil Nadu as a state is attracting a lot of these investments, not only electronics. Today we had a good news on footwear. The Taiwan footwear companies who manufacture and sell on their own brand and for Nikes, and they're setting up a big outlet in Tamil Nadu. So you're seeing some of that China plus one play out, but it still seems like it is more Vietnam, as this chart shows, if you look at investment, FDI, and exports, the green line is Vietnam. They've actually had a much higher shares, and the China person. I think Ajit, you had made a good point that maybe it is ethnicity. You know,
the
people
kind of
look,
food people want to
people
eat.
kind of the food that people want to eat.
Not everyone likes Indian Chinese food.
Correct.
So their original Chinese food.
The Chinese entrepreneurs are more willing to maybe, or it makes it easier for them to set up. Also, India had the China-India border skirmish. India didn't allow too much investments, but you can see that changing. India is now welcoming Chinese investments, and maybe that will also help kickstart the investment cycle, that if the demand does not pick up in domestic economy as much, there'll be some export opportunities, and we will see how that goes. But otherwise, as of now, it's not been a very, very great story. So given that background, we'll just talk about valuations. And one aspect of valuation that is very significant today is flows. And this chart, we've had some very nice things to say about the BJP government and the Modi government over the last 10 years. We've had some, not so nice things to say about, how they've managed certain economic decisions, demonetization. We've had our, opinions about it. But if there is one win that we think Narendra Modi himself has had, it's just to give that confidence to the Indian investor to invest in a risky asset class in the equities. And this has been a phenomenal story. As you look at cost, foreign investors are about $200 billion of cumulative investment. This is since the last 22 years. And mutual funds are now already at about $160 billion. So that's a significant increase in domestic inflows into mutual funds, and that has been you want to
right. And we circled 2 years, right?
Yeah.
Two periods. We circled Lehman,
Yes.
which was a peak, and there was withdrawals, as we see the next slide. And
Correct.
You've got Modi winning the standing for election in 2013-14. And you can see that dramatic shift.
Yes, absolutely.
So you have those redemptions that were there after Lehman.
Yes.
For 4 continuous years.
Yes.
Modi says he's the candidate in September 2013 for the election in May 2014, and the market gets charged up, and the run-up begins. And it's been incessant. I mean, excepting for COVID.
Yeah.
You had the issue of COVID, then you spoke about ILFS and other issues that were domestically, 1-2 month blips.
Correct.
But there's phenomenal flow and phenomenal confidence coming in.
Yeah.
Maybe overconfidence, some of your slides may indicate over time.
So what that has done is that, although earnings have not been very good, and if you look at this chart going back, take the 2017 line, the orange line on the left, this is sell side brokers estimating the earnings and EPS of the BSE Sensex, starting at the year with a very lot of optimism, and then as the year goes by and as they don't see corporate activity, earnings, and they're reducing the earnings. So if you see, from 2014 till about 2020, 21, flat line. I mean, hardly any growth in earnings. But of course, the bottom and the background is the chart of the Sensex, and that kept going up because of flows and sentiment and expectation. It changed in 21 and 22. If you look at the 21 chart and the 22 chart and 23 chart, analysts are actually being surprised. They're starting lower and they're seeing activity, or they're seeing profitability and earnings pick up, and they're actually increasing their estimates. And we've seen that continue. Maybe if you see the 25 number, you're already seeing some correction, right? It's not upward sloping yet. That means they are actually reducing their estimates, which also goes back to what I was saying, that the growth is not as high or as fast as we would expect it to be. And maybe there is some tempering of demand and we can take questions on that in terms of why that is happening. But broadly, we still see that consumer demand recovery has not been very high. But the earnings, there is optimism, some slowdown nearby, but this is what has happened to the valuation. You want to talk about that?
So you have you've got interest from people, international investors, and also domestic investors. So you've got demand for shares.
Yeah.
You have earnings that are not growing up, and share prices go up. So
Correct.
the price to earnings ratio increases, right? Of course, you did have the correction at COVID.
Yeah.
But you have then since a recovery, and it's still above the long-term average. But if you look at it compared to for example, the mid caps. So the mid caps are still trading at about a 40% premium to the larger caps. So that's a premium that you're paying in illiquid stocks, relatively illiquid stocks, where you don't have managements that are fully tried to grow to scale.
Right.
So you've got that risk that we spoke about at the start.
And if you get a cyclical slowdown, as we are maybe what we're seeing in earnings, right? It can have a bigger impact on the mid cap, because there the expectation is a lot more.
Though I think that when you look at investment vehicles into mid cap stocks, it is easier to massage or play around with the share price to support it than it is in a liquid stock.
Right.
So if you have illiquid stocks that are trading and the market doesn't look good, you first exit your liquid stocks. And it happens in every cycle that we've seen over the last 3.5 decades.
Absolutely.
Right? The liquid stocks get battered first because you need the money out. And then you see, with a slight lag, the illiquid stocks fall in. Because once you've taken the money out of the liquid stocks, you now want to redeem out of the illiquid stocks. And the minute you redeem out of the illiquid stocks, the massacre is crazy, as you see it in charts when we come to the BSE indices in India.
So like just on that point on why we are calling it a ticking time bomb. It's a significant thing that more Indians are investing in equities and mutual funds. So if I look at the household savings allocation, if I include property, right? So property and so real assets and financial assets, the allocation to equity through mutual funds and direct stocks is about 6%, right? But if I take only financials, it's about 11-12%. We are back at the time when we were in the 1990s again, when allocation to equities by Indian retail investors in the 1990s, 80s and 90s was about 11-12%. And then subsequent scams, Harshad Mehta scam, the Ketan Parekh scam, the dot-com bubble, it kind of deflated out and people moved away into insurance.
It went as low as 3%.
It went low as 3%. That 3 is on total basis come to 5-7%. And that 3 is, if I look at only financials, financial savings, it's about 11-12%. In fact, in the last year, 2024 and 2023, the incremental allocation to equities has been almost 20 to 22% of a household's financial allocation. US is about 35-37%. So we're already in a situation in a span of about 4-5 years, we're already in a situation where we're actually as close to global market. I'm not saying whether that's good or bad, but the incremental allocation into these markets have gone up a lot, into equities have gone up a lot. And as we saw that outflow chart, post Lehman, at that time, the bigger impact on outflows was from financial investors, foreign investors. They were actually much more allocated to small caps, mid and so, and we saw a lot of funds shutting down or having gates for about 2-3 years. Retail money was not as much invested, but today, as we saw those charts, the retail money is significantly invested in mid and small. And if there is a very large correction, I don't know whether it could have a problem on the regulatory side, on the political side, on the government side.
The regulator already has many problems on their hands, that's for sure. But it would, for sure. So again, when you spoke about the big cap, small cap, you look at this chart begins in 2005, around the time of the brick thesis that came out of Goldman Sachs. And when that thesis when that thesis got destroyed, you can see the correction after Lehman. And you can't see it on scale much, but the small cap, mid cap stocks indices fell by 60 to 75% at that point in time.
Correct.
The larger cap indices fell by 55%, they fell less. And it's taken a very long time. You can see the spurt from roughly 2022-ish. On the right side, you can see the small cap, mid cap stocks kind of zooming up there. And making up for lost time.
Right.
But it took a very long time to get a sensible rate of return. I mean, if you were to be a buyer of small cap, mid cap in 2007, you didn't cross that threshold till 2017. So for 10 years, just like NASDAQ had done, after the dot-com bubble, took a long time for NASDAQ to recover. Very similarly. So you have to time these markets if you're doing small cap, mid cap. But if you're doing long-term investing and you have a valuation tilt in a growing market, we're not, again, as a value manager, we're not distressed.
Correct, absolutely.
We're trying to say there is a growing market. It is a growing economy. We have no doubt about that. We're sort of pioneers in that thought process in some sense. So we're not disputing the growth. We just think there's a way to approach what you pay for the growth, that what we call value. And of course, we've got the governance that we talk about in a minute. The other interesting thing about quantum, just a kind of a slight sort of move away here, is that what we've had is the ability, since December 2005, we started estimating what we call the upside potential of the portfolio in 2 years.
2 years.
So what you think, if you buy something today at 100, if the upside potential 2 years from now is 20%, so it'll be 120 in 2 years' time. So every month for 221 months, we have plotted this chart. and the orange line is the estimate, and the blue is what we achieved.
Yeah.
So this is pretty remarkable that for equity in a moving economy like India, growing evolving economy like India, in stock markets where portfolios change and all that stuff, prices change, everything changes. We've had this phenomenal ability, which is very unique to quantum. We've also done that, of course, on the gross asset value basis, and you can see the benchmark of the BSE 500 out there with all the disclosures that everything that we talk about upside potential in the past is not necessarily something that will happen in the future. But with that, we can talk a bit about governance.
Yes, Ajit.
The last part of this three-legged stool of investing. So I have with me live the little white book of governance. I hope you can, if you go on our website, you can scan and you can download the copy, from there. But I think governance is something which is hit the newspapers recently.
Yeah.
Because of what the DOJ and the SEC have done with Adani.
Yes.
The indictment that's there, and you've seen the responses that are coming out from the government defending Adani. But I think it's something that we've experienced in our history a long time. And the stock market is fully aware of this.
Yeah.
All we have to do is have the discipline to listen to what the markets tell us. And a few slides to show that. So on November 21st, 2024, this is when the US Department, the DOJ, basically pressed charges against Adani. On the left, we had the markets were down 0.7% that day. On the left side, you've got the Tata companies. We respect them for their governance, generally very, very good at their governance. So they did, reasonably well, etc. that day, not many collapses. On the right side, we have a bunch of companies, Ambani, Adani, which in our view fail our integrity screening system, which we have, something we started in 96. And then we have others. These are companies with variable governance, sometimes good, sometimes bad. And on the bottom right, we have 3 companies from our portfolio, a sample, as how they performed on that day. And if you turn to the next page again, on June 3rd, 2024, this was the first day of trading after the exit polls for the recently concluded April-May elections in India. And the market was up on that day because Modi was supposed to win. And you can see on this slide, the Tata companies generally did not so good compared to
the index.
Now, if you add the cronies, I shouldn't say that word. I should use the companies with suspect connections and low integrity scores, I guess. You can see how well, they performed in this market, where Prime Minister Modi is supposed to win. Our portfolio companies right at the bottom right, they've not done so well against the index on a relative basis. On June 4th, the election results are announced. Prime Minister Modi has lost the election. The markets are shocked. The Tata companies with good governance and don't really work on government favors done reasonably well. On the right side, the companies that work with government connectivity as perceived by the market have done very badly. And our portfolio companies right at the bottom right have done reasonably decently on that day. And in a very similar way, going back a bit time in history, January 7, 2009, the founder of Satyam, that time India's 4th largest IT company, declared that he'd stolen $1 billion from the company and he put a fax out to the exchanges. The markets again fell on that day and the Tata companies did reasonably okay. On the right side, again, you can see the companies with suspect, sort of integrity scores.
Markets keep saying this again and again.
That they trust and who they don't trust. This is not us making a judgment. We're giving you the views of millions of investors acting on the market. It's for us to listen and write down that in our process. And we do that within Quantum. We have the integrity scores, which ensure that we don't make these errors. And that, when you said at the start, that is risk, where you lose capital, right? And the easy way out that many investors have is, let's buy the index. What's your take on that?
So index, as we've shown through charts itself, it has it does well, and it is, a lot of the growth gets reflected in index. But, the index is constructed for liquidity, with criteria of liquidity, free floats, and momentum. It's a very active, most of the indexes are very actively connected. They keep putting in companies which do well on a price momentum basis and remove companies out. They don't sit for governance, especially the benchmark indices, right? When you're talking MSCI India or Nifty 50 or BSE 30, that's where all the ETFs are based on. Or that's where a large allocator will do a customized index and buy. they don't sift for governance. And so if you're talking, and since we're talking about governance as a risk that investors should avoid purely from a headline perspective or a reputation perspective, especially if you're a very large institutional investor, passive indexing might have worked a lot in global markets in terms of returns, but if it works on risk, and this is Ajit's email to John Bogle. And so we were in the mutual fund, we were debating, discussing about whether should we launch just to have a tracker on the index. And Ajit wrote to John Bogle in terms of this is, and he sent a set of data, and I'll show you in the next slide the set of data that he sent. And this was John Bogle's response to Ajit, saying that he prefers classic indexing, even probably over value. And he knew we were value because we were also managing the Vanguard International Value Fund, where you were managing through Hansberger. But he just said that the industry strategy that you
talk about he said it sounds plain foolish because of the next slide. Because of the next slide. What you said about the index being very active, the BSE 500 in the year 2008 had 543 changes. Right. Now you mimic that, the transaction cost and all is crazy. We got the S&P right at the bottom, just to show how many changes the S&P have had. Yeah. Sure, they've had changes, of course, but nothing compared to the BSE 500. And if you go to the next slide, you've got the friction of taxation. Correct. So India has capital gains tax. So each time you buy and sell, and there is transaction cost, you got taxation, you got capital gains tax. And the short-term capital gain is 20%, long-term is 12.5%. So, there is a cost. So apart from the expense ratios and, the expense cost, there is a cost of churning. And governance. There's a cost of rebalancing, and there's cost of rebalancing. And as Ajit said, governance. So, we don't believe that, just buying the Indian passive indices is going to, you might get a bit of return, and of course, as active management has shown over the period, especially in India, you can, if you manage this kind of valuation and governance, there is a scope to perform. And we really believe that there are the likes of, as we say, the Enron and the WorldCom and the UCAS present in Indian indices in fairly large weights. And then you have to be careful when you're investing. Allocating capital, you're trading, you're investing for short term, but when you're allocating capital for a long term. Yeah, and if you're writing in your annual report how much you care about governance, you should not be buying the index. As blunt as that, right? Otherwise, you're just greenwashing. I'm mindful of time. We should summarize, and we will wait for questions. Absolutely. So again, we just said that you should invest in those places where there's high GDP. India has high GDP. You've got the linkage to stock market returns. That's been a wonderful thing that's happened in India. Vanguard had taught us and taught me what does it take to find the right manager for your capital. Because I asked him, why did they choose Hansberger and why did they choose me as a lead manager of the account? And they spoke about the people, the philosophy, the predictability of the process, research. Which we saw in our charts as well. Right? Absolutely. And about the performance. So these 4 Ps, and we as fund managers, as those who manage the allocations, look for long-term patient capital. The other aspect, of course, is clearly from a quantum perspective, we hopefully tick all the boxes. If you look at the 4 Ps out there with a long history, right from 1990, the Wall Street Journal article, to where we stand today. And on the next slide, we also have the integrity screen, something we started in 1996, which is the topic of conversation today about, governance to ensure that you be good, do good, as we say. Absolutely, invest in companies that are doing the right thing, and the market will reward them eventually over long periods of time. And therefore, for an allocator, or when you see the opportunity and you are worried about valuation and you are worried about governance, at the base of that triangle is where we exist. Correct. Because we are worrying about these things. Yes. And if you go up that curve, you automatically are surrendering the liquidity. You are trying to get the opportunity, but you're surrendering the liquidity. You're sacrificing a bit of governance, and you certainly are sacrificing valuation when you go up that curve. We are not saying that you don't do it. I mean, it's just that you sprinkle your assets, but the core allocation in terms of how we want to look at risk return, and as our track records have shown, that having this framework of liquidity, valuation, and governance can still generate fairly high risk-adjusted rate of returns. So with that, we can take some. Yeah, we are happy to take questions. As I said, if you have a question, you can use the raise hand feature, or you can type in the chat box. I think Kevin had some questions that had come through to Kevin or Nilesh.
We're
Yeah,
happy to
so
take that
we had a few email in advance. So while we wait, if any come up in the Q&A, let's just tackle a couple of those first. One was specific about quantum, asking about the upside potential chart that you showed. How is that? The question is, how is that different than just market valuations? So market value is high, we assume the upside is lower, and the reverse. Is that pretty much the same, or is it different? Your upside potential chart.
Can you repeat that, Kevin?
Yeah, the question is, so you showed an upside potential chart, but then
Yeah,
I guess the assumption is that if market value is high, market valuation is high, your upside is low, and vice versa. If market valuation is low, your upside is high. So is your chart saying something different, or is that pretty much accurate?
No, it's not so much the market as our own portfolio.
yeah.
But to some extent, it reflects it, right? If we don't see upside in our portfolio, which is significantly higher than the risk-free rate of return, you know, and what we aim for is a 15% compounded rate of return in rupee terms. That's what we aim for. And of course, you get the fat ball thrown at us and you whack it out during Lehman or during COVID. You get great opportunities and you get a much higher rate of return. But we aim for that risk-free rate of return plus equity risk premium, plus the fact that we think we're smart and we should earn a little more than the market. So it's really a reflection of our portfolio. But of course, our portfolio is a reflection of market opportunities. So you can take our upside potential as a proxy for what you think the market will do, but it need not necessarily be true, because there are periods in time when value stocks are loved and periods of time when value stocks are hated. I'll give you an example. Our portfolio turnover by name is 10%, i.e. we own a company for 10 years. Our portfolio turnover by weight is 20%, because you may trim in and out of a company given certain market opportunities. But in December 2019, they pretty much the same portfolio, given the fact that we've got a low portfolio turnover, as I indicated. The same portfolio we have today, similar-ish portfolio, was third and fourth quartile in 2019 December. Now it's first, second quartile. And the portfolio hasn't changed much, but the way the market views us has changed dramatically. So yes, it is somewhat of an indication of what the market will do, but it's much more of an indication of what we will do in some sense in the outcome. Yeah. And you know, we had given this to a statistics professor, the upside potential data, and he said with a 95% confidence level, i.e. 95 out of 100 times, we'll be within a very tight band of what we estimate. So it's very statistically significant estimation from our side. There's an email here that we've got, the question, which we can read with the question. Yeah. Given the surge in IPOs and the projected continuation into 2025, what criteria do you employ to evaluate the investment potential of these new market entrants? How do you balance opportunity against the risks with new listed companies? Very simple. We don't generally buy listed companies. Yeah, IPOs. Oh, sorry, we don't buy companies at IPOs, newly listed companies. Yeah. So a company doing an IPO chooses that investment banker who walks in the room and says, I will get you the highest price. I haven't heard of a company that chooses an investment banker who comes in what they call a beauty parade and says that I will give you the lowest price, and the CEO says, perfect, you're hired, right? You're not going to do that. Yeah. So the minute you're choosing a banker based on the highest price for the company, chances are it's not good for you as an investor. So we don't really pick up stocks at IPOs, particularly those of new age businesses where the history is very short and there's huge cash flow burn, et cetera, or, you know, we don't do that. So that's not something that we have to worry about per se. And then another question was, if the economy is slowing down now and growth disappoints, how would your strategy deal with this? Chances are that when the economy slows down, the markets don't like that and there's a sell-off. Yeah. Our strategy would be to look at that long-term growth potential of the Indian economy and of every sector that we study and examine within that economy, and every company that we track and study within that sector. Chances are that when there's disappointing news in the near term, the markets have a sell-off. And chances are Subbu, Nilesh, I will be jumping on the table and telling you, give us a lot more capital, because we can see when you extrapolate it to a normalized GDP growth rate, and a normalized rate of growth in that sector which the company operates. And if you like the management, you like the balance sheet, integrity scores are good, we'll probably be buying a lot more of those shares at lower prices. So the answer is we would wait for that to happen. And that's when the upside potential, goes to the roof. And we saw that in two events, right? With the global financial crisis after Lehman's bankruptcy, September 15, 2008, GDP around the world, including India, went down. We saw that after COVID, GDP around the world, including India, went down. So that was not an economy slowing down, that was economy falling off a cliff, and the world falling off a cliff in two instances. And we immediately flagged to our investors that it was a fantastic time to invest.
So we are essentially bottom up investors, right? So we are very valuation focused in terms of, in a normalized world, what is this company worth and what is the intrinsic value of this company, and if it's available at a discount to that intrinsic value, we will buy. Of course, whatever changes has to happen on the intrinsic value gets reflected through our numbers, right? Correct. The analysts are going and meeting that's their job. They go and meet companies and managements. And if they're able to figure out, it'll get reflected in the earnings and hence the valuation.
Yeah. Kevin, any more questions?
In advance, I only two more that came in, and one is on valuation and one is on governance. The valuation question seems a bit more optimistic than the last questioner, which it suggests that there are expectations that after a slowdown, earnings will accelerate going forward. And your chart showed the PE coming down in the recent past, sort of. So is there an argument to be made that, given the expected earnings growth, that valuation is actually not too far stretched at the moment?
Yeah, it's not too far stretched. If you look at our own cash levels in the value portfolio, they are, the highest cash level has been 30% or thereabouts on a free form basis going back to 2000 August till now. We very rarely are below 5%. Most fund managers are too scared to be above 5% because clients may fire them for sitting on cash. Our belief is that clients will fire us for being stupid. So we choose not to be stupid and be very disciplined. But our cash levels today at 16, 17% are higher than our long-term average of 10%, but they're not at the peak. But, clearly, I think we saw a bit of a market hiccup in the last couple of weeks. That's given us some opportunities to put some capital back in, obviously. But on the thing about the P ratio coming down because earnings are going up, that's true to some extent. But recognize there's again been a slowing of the economy in the near term. And there's concern that, as Arvind pointed out, when you saw the consensus earnings estimates, it started flattening out. And there was some correction of the optimism that was there for FY 2025 and for FY 2026, March 25 and March 26. So yes, when the cycle turns, that earnings will get better. But in the near term, the prices are coming down. And that's sort of why the PE ratio comes down. The price action is more than the earnings going up at this stage. But over the next couple of years, that will be true.
Also, as we showed again, it's a bit different in large caps in Nifty 50, which is the large cap index, which is what we showed, and then the mid cap. So the mid cap valuation, as you still see, is much wider and much higher than long-term averages.
So the only other question I see is switching subjects to governance, and the question was about bribery charges being brought against a large conglomerate in India from the US. And the question related to that is where's the Indian regulator with respect to these type of governance issues? Why did that accusation and indictment have to come out of the United States?
So I think the Indian regulator is failing India. I think there are two aspects of governance that have been very surprising and very, very disappointing to us as long-term investors in India. So when you have a large conglomerate, as what is being referred to now in the case of the DOJ and SEC charging against Adani in India, when you have a large conglomerate very close to government, we've seen the government wrap that corporate in a national flag and national pride, that we built this national champion and we have this foreign intruder telling us how bad our Indian conglomerate is, and they've draped that Indian conglomerate in a nationalist Indian flag. That's dangerous. That's very, very dangerous when you have that. And that's why you have that disconnect of the chart of China's GDP growth rate and China's stock market. Because what you really have is you've got, cronyism in some sense that has taken over in China and in Russia, Putin, etc., and Turkey, and you don't want that to sort of take over India. You've had pockets of it for decades, which is fine, but much of the market has been sort of decent in that sense. So I think the governance has failed in India because SEBI, the Indian regulator, gave a clean chit to the Adani Group for a different allegation, not the same one that the DOJ and SEC are after, but a different allegation. And they said there was nothing wrong in what that group had done for the other incident. And then in India itself, a large bank called ICICI Bank is taking over its listed subsidiary called ICICI Securities, ISEC for short. And they're doing it at valuations which, to our view, are detrimental to minority shareholders. We are shareholders in both the companies,
Right, yeah.
but it would hurt us more as a shareholder of ISEC, where we have a larger percentage stake than we do in the main bank. And we think they're basically taking it away from us, not from all minority shareholders. We're losing $1 billion plus US at the value that they're doing it. And SEBI, the regulator, has given ICICI Bank the leeway to do this. We're actually in court. Quantum has never been in court for any issue with the company.
Like we've never been activists.
We've engaged with, and if we don't like something company does, we sell out and we walk away and never buy them again.
Right.
And that's done. Our integrity scores on that company become very low. But this time we've actually gone to court. We're in court against the big bank, ICICI Bank, whose pockets are far deeper than us. And we're also trying to get the regulator called to court to defend minority shareholder rights. To me, that is a far bigger signal of governance failure in India than what's happened to Adani, because Adani is political. No matter who the head of a regulatory body in India is, there will always be some political pressure on that person to say things and do things that please the government of the day, no matter who the government is. And it's happened under different parties over decades. We've seen it, and that's fine. That's a different level. But this is not a political movement. The ICICI Bank is a private company. The regulator, the chairperson of the regulator worked for the bank. The chairperson of the regulator used to be the head of that broking company while it was still an ICICI Bank, before it was listed, etc. So there is a lot of not so nice stuff optically that's happening there. And we don't like it at all. And, which is why we were keen to have this and just remind people that while there are opportunities, the valuation part we can take care of. We've got a 24-year track record of playing playing around the risks of what you see of hypervaluation and optimism, and then of ultimate despair through our disciplined processes on research and portfolio construction. But governance is something which, if the environment becomes not so nice, we will come back and tell investors, be careful, because the risk in India just went up. Not volatility, but the risk just went up. And I see that
I think you should want to take that question. There's a question on quality and governance, of course, comes at a price and typically at a higher valuation. And you want to talk about the Q India value equity process.
Correct. So, definition of value, right? I mean, as a head of Hansberger's marketing used to always say in his very southern accent, value like beauty lies in the eyes of a beholder. Yeah. So I think one of the unique things about Quantum's valuation approach is we do not use DCF. DCF is not the primary model, and we're probably one of the few value managers out there who doesn't use DCF. I gave 2 talks in the course of the year, and basically, it was like, we don't do DCF, we do other stuff. But we try to understand the business of that company, of that sector. We try to figure out the normalized long-term demand. And your definition of value is you're seeing the growth, you're seeing the opportunity that offered in India, but you're buying stocks at sensible valuations. You're waiting patiently with capital. I think the most important thing in investing is getting in at the right price and getting into a stock for the right reason.
Yeah.
What are the catalysts for that re-rating that you expect in the future? But it's a long story. We can have another webinar on that.
Yeah.
But just, anything you want to wrap up, because I think we're just about crossing an hour.
No, in terms of the governance part, that what you talk about, because a lot of institutional investors were invested in private markets and in the cases where it was referred to the SEC, I think you will see either some skepticism or some slowdown in a lot of long-term capital, which India needs in infra and real estate, to kind of slow down a bit. I think that will be an outcome of that. But otherwise, as you said, we've seen some cyclical slowdown on the economy, but we still, as we see, even like if you look at wealth of India, gold prices, India has a lot of money in gold, and gold prices have gone up. So in the financial wealth, equities, people have actually made reasonably good amount of money in equities. So you see some amount of consumer demand coming through, and the government takes some more steps on spending and improving incomes. And we've seen that in state governments, where every state government election has seen a significant dole out of money. I think we'll see that increase in.
So I'd like to just sort of end this webinar by taking a quote from our book, actually, it's on page number 83. For those of you who've gone to our website, qasl.com, and scanned it. It says, good governance gives minority investors confidence that they won't be forgotten or ignored. Just, it's a very simple statement pertinent to us as custodians of your capital to invest in India. And when governance is at a question, as we just spoke about the regulator in India, I'll add a quote of mine on this, which is that the US entities, US corporations have outsourced their software and technology maintenance to India. India seems to have outsourced its governance to the DOJ and SEC. That's quite a negative statement on the current conditions in SEBI. And I say that to someone who's very emotionally involved with this case that we have in court right now, fighting for your rights as long-term investors in India's capital markets. So with that,
thank you so much for joining. This has been wonderful. If you have any further queries, if you want to know more, please write to us. We'll be happy to have a conversation going with you.
So wish you all a Merry Christmas and a fantastic New Year. And we'll see more of you all in the New Year for sure. Thank you again.
Thank you so much. Thank you for joining. Thank you.